So thanks everyone for finding the time to join the webinar. That's the first one actually that I'm doing. So if it's if you've got any feedback later, it would be great to have. So today we'll talk about the taxation in the UK. We get the when we have initial client meeting with the businesses that have never run the limited company or who's recently started, they get confused. There are many taxations types in the UK, and we'll just give an overview. And if you've got any questions, we'll have a Q&A session, and you can start typing the questions on the go as well. I'll try to answer either within the meeting or later. And very quick introduction, if someone doesn't know me, I work for the Q Accountants, and at Q Accountants we work with the startups and SMEs in the UK, and we specialize in providing fixed fee packages where we include all the services that average startup needs or SME needs, from bookkeeping to VAT return, from payroll to annual accounts. And also we help with the R&D tax credits, SCIS, I'll talk about them as well later. So let's carry on. So plan for the day. I don't like spending half an hour for the introduction, but let's quickly go through it. So we'll talk about the different types of the taxes that we have in UK, and then we'll talk about how to reduce those taxes, i.e. about tax reliefs. And we'll just finish with a Q&A session. Right, so before going to the taxation, just wanted to clarify something. People get confused often between the HMRC, HM Revenue Customs, and Companies House. Often the clients say, yeah, have we submitted tax return to Companies House, or we've done annual accounts to HMRC. So when we talk about the taxation, we are talking about HMRC. The Companies House is where we are submitting the annual accounts and where we're submitting the confirmation statement. It's got nothing to do with the taxes. So today we're talking about HMRC and relevant taxes, not Companies House. So world of taxation. If we think that the HMRC is an organization that handles the taxes, it's got different departments, and every taxation is dealt with different people. So we have the VAT, we have corporation tax team, we have self-assessment tax team, and every time you're giving them a call or you want to discuss, you need to find a specific number for every different department. So we'll start with the easy one, corporation tax. So how does it work? What is a corporation tax? It's very simple. So you have total sales in the company, and we are deducting the total expenses, and whatever you have is net income, right? And from net income, you're multiplying to corporation tax rate, which is 19%, and you have corporation tax to pay. So again, let's say your business is doing issued the sales of 100,000, and you have employees, you have rent to pay, you're calculating all the expenses. Let's say there are 60,000 of them, so your net income is 100,000 minus 60,000, you have 40,000, and you're multiplying it to corporation tax rate, which is currently 19%, and you have your corporation tax bill to pay. With the corporation tax rate, there were some plans to reduce it to 17%, but if you follow the news, looks like it's not going ahead, so it will stay 19%. In the past, it was way higher, so and 19% is a pretty good one if we compare with the G20 countries. Deadline. So you have if you started your company, let's say today, so you have next 12 months. When 12 months end, that means your first set of financial year ends. And after that, you have, it's a bit weird. So you have 12 months to submit the tax return, but you have to pay tax, corporation tax in 9 months. So therefore, if you need to estimate if you haven't done it within 9 months and to pay corporation tax, and then you still have 3 months to submit it. So what many people do is just, what many businesses do, you just complete and pay tax return within 9 months after your financial year end. So if you start your company today, you have pretty much 12 months plus 9, so you've got 21 months before you pay your taxes. Obviously, it's better to put some taxes aside, because if you leave it till the very end, can be quite a burden. Next one is a VAT. So yeah, let's first of all talk about, do you have to register for VAT? Not every business needs to register for VAT, and first thing to look at is threshold. What's your sales? How much you're making during a year? So it is right now in UK we have 85,000. So if your business is doing 85,000 a year, you have to register for the VAT. However, there is a big difference between. Many people get confused if you're having, for example, if you work with the US companies, or if you work with the Europe mainly, if you don't have UK clients, that is not included within your threshold. So you can have a company that does £200,000, but if 150,000 of it relates to US sales, then you don't have to register for VAT. So we're looking at how much you're making in UK from UK sales, and if that exceeds 85,000, you have to register for VAT. What if it is not that high? You can still register for VAT. That's called voluntary registration. It can be beneficial. I mean, you can ask, like, why would I do that? Let's say, let's take this example as your sales are mainly abroad, like US. You're issuing the invoices to them. You don't include the VAT on top, but you have expenses. You're paying for rent. You're getting the laptop. You have other equipments to buy. What about the VAT on them? So you can, if you're registered for VAT, you can claim that VAT back. So yeah, so that can be beneficial. Still maybe worthwhile looking into the registration if your sales are not 85,000. Here we have different rates. Mainly we're talking about 20% VAT. So we've kind of, I would say 99% of the products and services would be 20%. There are some products with a reduced rate, 5%. It will be, you can have it within the energy industry. Some products are zero rated. Let's say that the books or the children's clothes will be zero rated. Like water, zero rated. But mainly, again, we're talking about the standard rate of 20%. And how does it work? Let's say if you have sales before VAT registration, I'll give an example. If you have a consulting service, you've done some consultancy work, you've done work for £1,000. Now you have to increase that £1,000 by 20%, i.e., £200. So if your customers were getting the bill for £1,000 before, now they will get the bill for £1,200. So it can be quite can have a quite big difference. Regarding expenses, same thing. Again, if we're talking, I'm assuming that we're talking about a standard rate, 20%. So you can claim 20% from your expenses. So before VAT registration, you get all these expenses. You can't get this 20% back. If you are VAT registered, you can just claim the VAT from these expenses. So, and how does it work? We're calculating whatever you have to pay to HMRC from sales, and then we're reducing that amount by the amount of VAT from your expenses. And usually that would exceed the sales, VAT on sales will exceed the VAT from expenses, and if it does, you have to pay that amount difference to the HMRC. And if it's other way around, you will get a check from HMRC, or if you provide your bank details, you will get the electronic transfer. You will get a VAT refund. Mainly, you are doing this once a quarter. I'd say majority of the businesses would do it once every 3 months. Some businesses may be required to do it monthly. We're talking about bigger companies, and you have an option to do it once a year as well to reduce the admin burden for the smaller businesses. I personally don't like it because it's getting tricky. You're usually paying one fixed amount every three months, but then towards the end you have to make an adjustment. And again, depending on how your sales went, you may end up paying much more than you anticipated. B2B and B2C, the reason I put it here is if your business is mainly to do with other businesses, so if you're supplying this consultancy services to other businesses, probably they are VAT registered. I mean, if they're not very small companies. And if you're into the B2B, my advice would be probably it's worth registering for VAT, because from one side, your clients, they don't mind paying VAT because they'll claim it back anyway, and it's good for you because you can claim your VAT from your expenses. In terms of B2C, that's a tricky one. Yeah, if you are, if you're a small cafe or if you're a small corner shop, if you were selling something for £10 to me or to someone, to any other individual, and then tomorrow when you're VAT registered, you have to do it, you have to charge us £12, and there's no way I can claim that back as an individual. So I can, if I was getting the cake for £10 and tomorrow it's £12, I may think twice before getting it. So for the B2C, it is tricky. For very small businesses, it can be quite damaging. But for B2B, it's probably a good thing to register for VAT. The deadline, so as I said, mainly we're talking about the quarterly VAT return. You have a deadline of 1 month and 7 days after the VAT quarter ends. Let's say you register for VAT in 1st of January. So your first VAT quarter will end 31st of March, and your first deadline to submit the VAT and to pay the VAT to HMRC will be 7th of May, 1 month and 7 days after the deadline. Deregistration, if you did register for VAT because your VAT threshold, you exceeded VAT threshold or you voluntarily registered, it doesn't matter, you're VAT registered the business now, but the business doesn't go the way that it was, and you're actually deciding, well, it's not worth for me to be VAT registered because I'm doing only 70K a year and I'm mainly working with the B2C market. So it will be beneficial to deregister. You can do that. It's not a problem at all. But again, you have to be below £85,000. The only thing to watch out, main thing to watch out in the VAT deregistration, if you have any assets, let's say you bought the big equipment for your company and you claim the VAT on it, once you deregister for VAT, you have to take that into account because you still have that asset with you. You still use that laptop or equipment. So you need to return some VAT that you got within the VAT registration period back to HMRC. Personal tax. So yeah, now we're talking mainly in this session about the limited company, but if you're running the limited companies, you'll have to pay the personal tax as well. How does that work? You have income tax on salary. I split it like you have an income tax on dividends and NIC. With national insurance contribution, it mainly you would mainly see if you're employed, you will pay national insurance contribution, and you would pay it if you are self-employed, i.e. you're a sole trader. So we're not really covering NIC today. If you're paying yourself a big salary, yeah, you will pay NIC, but I'll mention it later. It's not worth paying yourself bigger salaries. You're always paying the amount of salary where you don't really pay NIC. And the tax rates is First £12,500 that you earn as an individual from your, doesn't matter, from salary, from dividends, from whatever your combined income, it is tax free. You don't pay any tax on first 12,500, and usually it is growing every tax year. And the tax year, by the way, in UK runs from 6th of April to 5th of April. So you always check how much you've earned during this period. And if it doesn't exceed 12,500, you don't pay any taxes. And then you have a basic rate of 20%. This is from, you have basically you have 12,500, and next 37,500, it's 20%. If you have a salary, if it's 20%, if it's a dividend that you took, it will be only 7.5%. And you can see from here why it is more beneficial to take the dividends rather than salary. And high rates, if you're earning more than 50,000 per annum, you're paying 40%. And again, for the dividends in the brackets, it will be 32.5%. And if you are lucky to earn more than 150,000 per annum, you start paying whatever exceeds that amount, you start paying 45%. But it doesn't mean that you are paying 45% from all income. It's all like marginal. You're paying, it's tire based. You're paying 20% from the basic, and then 40% next 100K, and then whatever above 150K, you start paying 45%. So that's a personal tax. And in terms of dividends and salary, all depends on the personal circumstances. Do you have any other income? Do you have property income? Do you have savings income from elsewhere? We consider every client's case individually, but let's say your business, the income that you're getting from your business is the only source. If that's the case, you have to, the basic scenario, you're getting minimum salary it will be around £700, slightly more than £700 a month, and whatever the rest of money you're getting as dividends. And that's I would say that's most basic tax planning for the limited companies. It's if you don't have that in place, definitely worth reconsidering. A deadline. So you have to submit a self-assessment tax return once a year, where you are declaring your personal income from all the sources. If you're tax resident in UK, it's self-assessment is a separate area. We can talk hours about that. But in short, if you're tax resident in UK, you have to declare worldwide income. If you have any earnings from elsewhere, you have to include that. Obviously, you are deducting taxes that are already paid in a different country. So yeah, you're collecting all your income. I have a property income, I have a bit of salary, I have a bit of dividends. You're collecting all of them, and then you're declaring in the different section of self-assessment tax return to HMRC. And again, we're looking for the tax year from the 6th of April to 5th of April. So the recent one was started 6th of April 2018 and ended 5th of April 2019. And you have a deadline before 31st of January. It's quite generous, HMRC, with the deadlines, I would say, in this case. So we, for that tax period that ended, we still have some time to submit it, which will be 31st of January 2020. And that's when you're paying tax as well. Tax reliefs. So as I said, you have to pay some tax, but there are some basic things that you can do. You need to be aware, and it may not be relevant for every business, but let's go through them. Business expenses. That's a very, I don't know, I wouldn't say it's right to call it maybe tax relief, but business expenses is the first thing you need to consider. Many businesses miss out from the expenses that they do incur. They may not realize that it is business expense, so it's worth checking what is personal, what is business expense. And obviously, if it's a business expense, it's better to run it through the company. General business expenses, what I mean by this is you pay for us accountants, you pay for lawyers, you have rent, You have your employees and the stationery, software, the training. It's something that is missed, by the way, very often. So it's a general business expenses salary. So again, I mentioned before that optimum level of salary and dividends. If you remember, prior to that, I said tax on dividends is lower than in salaries. And you can ask me, like, why don't we just pay everything as dividends? Just because there is a difference between dividends and salary. Salary is business expense for your business, dividends is not. So it is still worth paying yourself some salary so that it is a business expense for your limited company and it does reduce your net income and you eventually pay less corporation tax. And last one, pension. It's one of the most efficient ways of reducing your corporation tax. So every person, you have this 40,000 pound of annual allowance for pension. So you can put that through the company. If you are, let's say, a shareholder and sole shareholder and director of your limited company, your company can pay into your personal pension pot that 40,000 pounds per annum, and it will be business expense for your company. So you'll end up paying corporation tax, less corporation tax. Right, we're moving on to the real tax reliefs, research and development tax credit. That applies, again, this is a separate topic, and I'm sure we'll have a webinar on this separately, but very shortly, if your business is doing something new, if you are developing the app or the software that doesn't really exist, or it doesn't have to be in software. If you're thinking on some procedures, some processes that didn't exist before, you can for the time you spend, for the amount of salary you pay to the people who work on that, or if you hire subcontractors to develop this and the soft, you get the tax relief back. If you have to pay corporation tax, for example, that will be simply reducing that corporation tax to HMRC. Sometimes that's a common scenario in the startups. If you don't have any corporation tax to pay because you're a loss-making company, because you just at the initial stages you're just spending and spending and spending, then you get the tax back. Once the tax back, you never pay the tax. You get the tax credits from the HMRC, and it can be quite significant. So it's roughly speaking, again, it totally depends. So roughly speaking, we're talking about 20-25% of your expenses. So yeah, it's definitely worthwhile checking whether you are eligible, and this is one of the services we provide to our clients as well. The next one is SEIS, which stands for Seed Enterprise Investment Scheme. It's not really for your company. It's more beneficial for investors that willing to invest in your company. Let's say you've got an idea, you're starting the startup. It doesn't have to be startup, pretty much any company. There are some companies that are not eligible, like property companies, for example, like accounting firms were not eligible for this scheme. But essentially, if you are raising investment for the first £150,000 that you're raising for your company, whoever invests in your company, as long as they paid enough taxes in UK, they will get 50% of the taxes back. That's like a very, very cool, sexiest tax relief I know. So, for example, if you even that applies to you, if you want to invest in the startup, let's say you're investing £1,000 to the startup, if they have this SEIS relief, you get £500 back. And this is not the end of the good news. If you are, when you sell these shares, or when the investors sell these shares to someone else, usually if you're selling the share and if it's worth more, you're paying capital gains tax on it, like if you sell the property, your home. So and with the SEIS, you don't pay capital gains tax as long as you kept these shares within 3 years' time. So yeah, if you are at the stage where you feel like I may need some investment, and you don't have, let's say you don't have that much to persuade investors, this is something that you can consider. You can have this relief for your company, and then you can approach your friends even, and explain how does it work, and that they will get this 50% relief. So again, we're helping the companies to get the HMRC assurance, the piece of paper that shows that investors, guys, if you invest in this company, you will have this 50% back, and also will help with all the admin that is with issuing the shares, and we're helping the giving the certificates to the investors that they can use to get this tax back from the HMRC. What if you want to raise more than 150,000? If you do, then you're still eligible. The investors are still eligible for the tax relief. That's when SEIS, Seed Enterprise Investment Scheme, that you see in your here, it goes to the Enterprise Investment Scheme, EIS. And it works pretty much the same. It's just the tax relief goes down from 50% to 30%. Still cool. Its idea behind is whoever raises more than 150,000, they are probably been in the market for a longer time, and they're probably less riskier investment to make. So you're not getting the same benefits as SEIS. About us, as I mentioned, we're a team of accountants based in UK, and we work with the startups and SMEs. Our approach is we do everything that clients need, and we're coming to you, and you don't have to worry about your taxes. What is the next one? It's all good to understand, and that's a whole point of our webinar. We try to give as much as possible in terms of knowledge and experience to our clients, so that they understand what is next. But at the same time, our approach is that our clients need to concentrate on their business, and we give them this relief for taking care of all the accounting and taxation. We're based in London. That's our lodge in the Mindspace, where we're based in. We're based in Aldgate, and we have a branch in Sheffield, newly launched. So yeah, it's for any northern companies that are interested in our services. And that was it. Thanks very much, everyone, and I'll see you later.